Hello everyone, welcome back to my channel. As we all know, the Federal Reserve has been keeping a close eye on inflation and the state of the economy. Recently, there has been speculation that the Fed might pivot away from its current monetary policy, but I believe that this is unlikely to happen in the near future. One of the main reasons for this is that inflation is still running higher than the Fed's 2% target. While the recent CPI numbers did come in as forecasted at 6.5%, inflation is still very high, and the Fed will likely want to see it come down a lot further before making any major changes to policy. Loosening monetary policy too quickly could lead to another inflation surge, which would be even harder to contain. Let's begin by looking at the previous inflation cycle, the gray inflation of the 1970s, and how the Fed's actions at that time led to another round of inflation. We can clearly see that inflation dropped significantly in late 1974. That was because the stock market crashed and led to a negative wealth effect. Stock market crashes always have the Federal Reserve panicking and lead to a pivot. When they pivoted, inflation began surging again, and we had another round of high inflation in the late 1970s until 1981. I am confident that the Federal Reserve has been studying this particular mistake, which is why I believe they will be very careful with pivoting too early in the current inflation cycle. They have a wealth of data and economic forecasting tools at their disposal, and they will not make a move until they are sure it is the right time to do so. I have been saying since 2022 that I still think the 10-year government bond will top somewhere around 5%. There is no way the Federal Reserve will pivot with inflation around 6.5%, and after having made this mistake in the past. Instead, the pivot will likely come when the market is crashing, which will cause panic and a negative wealth effect, leading to deflation. As you may know, the Fed's current policy of raising interest rates and reducing the money supply has had some success in controlling inflation in the short term. But it's worth noting that unemployment remains at historically low levels. This suggests that the Fed's efforts to create unemployment as a means to decrease demand and curb inflation have not been as effective as they had hoped. But it's important to keep in mind that the Federal Reserve is always monitoring economic data and may make adjustments to its monetary policy to achieve its ultimate goal of controlling inflation. If the Fed were to pivot and adopt a more expansionary monetary policy, it would lead to an increase in the money supply, lower interest rates, and ultimately stimulate economic growth and increase demand. This increase in demand will lead to businesses raising prices to keep up, which will lead to an increase in inflation. This trade-off between lower unemployment and higher inflation is a crucial consideration for the Fed. Additionally, a more expansionary monetary policy will also likely lead to an increase in borrowing and spending, which can also contribute to inflation. It's also important to note that the market is still following the same old playbook in the disinflation cycle. In the past, when PMI was low, the Fed always jumped in with quantitative easing (QE) and rate cuts to get the economy back on its feet. Back then, inflation was very low, and this was very easy to do. But now, inflation has cornered the Fed, and if they were to apply the same methods in an inflationary cycle, it would lead to inflation getting out of control. It is crucial to understand that the current state of financial conditions is not in a worrisome state. Despite recent rate hikes, financial conditions have been steadily improving and are nowhere near the levels of stress seen in 2008 and 2020. This is another clear indication that the Federal Reserve does not see a need to pivot its monetary policy at this time. Furthermore, the S&P 500 is currently at historical high levels, and there is no indication of panic in the markets. This is another indication that the Fed does not see a need to pivot its monetary policy. It is important to remember that the Fed's primary goal is to curb inflation and maintain price stability. The market is not always correct in its predictions. Some market participants may be seeing things that aren't there and believe they can front-run a pivot. But it is important to remember that the Fed is not so easily swayed by market sentiment. It will make its decisions based on hard economic data and careful analysis. Front-running a pivot here could end up being very costly. Please let me know what you think in the comments. Do you think the Fed will pivot with inflation at 6.5%?